The Forex market or foreign exchange market is the largest financial market in the world. Every single day, more than $6 trillion is traded globally. To put that into perspective, this is larger than all stock markets combined. Unlike traditional markets like stocks or commodities, Forex does not operate from one central exchange. There is no building, no fixed location, and no single system controlling it. Instead, it is a decentralized global network where banks and financial institutions trade directly with each other through electronic systems. This is why Forex operates 24 hours a day across different countries following global financial sessions. Even though Forex looks chaotic on the surface, it is actually highly structured. The entire market runs through a network of institutions that are all connected. There is no single control center, but there is a clear flow of power and liquidity. Prices are not decided in one place. They are formed through constant interaction between buyers and sellers across the world. Every second, thousands of institutions are placing orders, adjusting positions, and managing risk. This continuous activity is what creates movement on your charts. To understand Forex properly, you need to understand its hierarchy. At the very top are Tier 1 institutions. These include central banks and major commercial banks. They are the most powerful players in the market and control the largest flow of capital. They don't just participate in the market, they influence liquidity conditions and long-term price direction. Below them are Tier 2 participants. These include hedge funds, large investment firms, and liquidity providers. Their role is to manage massive funds and distribute liquidity across different parts of the market. They often follow or align with institutional flow created at the top level. At the lowest level are retail traders. This includes individual traders like us. We do not interact with the market directly. Instead, we access it through brokers who connect us to the broader institutional network. So when you place a trade, you are not trading against the market. You are participating in a system dominated by large institutions. This structure is extremely important because it changes how you interpret price. Most beginners think price moves randomly, but in reality, price moves because of institutional activity. Retail traders only see candles moving up and down, but behind every move, there are large buy and sell orders being executed by institutions. When you understand this, you stop reacting emotionally to price. You start thinking in terms of intent and positioning. At the core of Forex is something called order flow. Order flow simply means the real-time balance between buyers and sellers. Every transaction in the market requires both sides. A buyer and a seller must agree on price. When buying pressure becomes stronger, price rises because sellers demand higher prices. When selling pressure dominates, price falls as buyers step down. But here is the important part. Price is not just moving randomly between up and down. It is constantly searching for balance. This process of balancing supply and demand is what creates all the movement you see on charts. Even strong trends are just imbalances in order flow playing out over time. Imagine a situation where a large bank wants to buy a huge amount of currency. They cannot enter all at once. If they do, price would spike too fast and they would get a bad entry. So instead, they accumulate positions slowly over time. This activity creates the slow pushes, pullbacks, and manipulations you often see on charts. What looks random to a retail trader is actually structured execution by institutions. The Forex market is not chaotic. It is a highly organized system driven by institutional participation. Once you understand this, your entire mindset changes. You stop seeing candles as random movements. You start seeing them as footprints of a larger player's moving capital. And when you reach that level of thinking, You are no longer just reacting to the market. You are learning to read it